Hello, thank you for joining us and welcome to our webcast, Building Australian Diversified Funds. I'm Rebecca Pope, Head of Intermediary for Vanguard Australia. Today I'm joined by two experts in their field with quite different backgrounds, so they'll be able to offer us their unique perspectives and answers to your questions. First joining us from Morningstar is Tim Murphy. Tim has a wealth of knowledge, having been in the industry for over 20 years, and is now a Director of Manager Research at Morningstar. We also have Aidan Gayson, who leads investment strategy for Vanguard Australia. Aidan will offer some valuable insight into how and why we build our diversified funds range. Welcome, Tim and Aidan.
Thanks, Rebecca. It's great to be here.
Thanks, Rebecca.
Before we begin, I'd like to remind you that the webcast will run more efficiently if you close any other browsers you have open on your computer. We'll also be answering your questions today, so please submit them in the side panel on your screen and we'll get to as many as we can. Our focus for today is on our Vanguard's range of diversified funds. Our investment strategy group recently undertook a comprehensive review of the fund's asset allocation and subsequently made some changes that we believe gives your clients the best chance of investment success. At the same time, we continued Vanguard's mission of lowering the cost of investing by reducing the fees across all four diversified funds, with all MERs now at 29 basis points. To kick things off, Aidan, you've just published a white paper on the construction of these funds. Can you share some insights into your analysis and considerations when building the diversified funds range?
Absolutely, Rebecca. I'd be happy to. And the first thing I'd say is that we do review the asset allocation of these funds on a regular basis. And periodically, you could expect us to make some changes to these funds just to ensure that they continue to align with our current best thinking. When we think about the role that these diversified funds play in your client portfolios, we think about it along the lines of four fundamental principles, being balance, goals, cost, and discipline. So on the goals side, firstly, we want to have a range of funds that represent different risk profiles so that you can tailor those to your individual client goals. From that, we get our broad strategic asset allocation to both growth and defensive. We then want to have a really good balance of risk and diversify by asset class within that. From a cost perspective, we think that's absolutely critical, and that's about us being able to leverage our scale to really deliver as much of the market return to your clients as possible. And lastly, around discipline, which is sort of twofold. Firstly, it's the rebalancing that really help the funds, stay on track and deliver what you would expect them to deliver. And secondly, it's the discipline that's really on the client as well and being able to actually stay the course with their strategy. And it's that aspect that we see the advisor playing a really critical role.
And maybe if you could just expand on that a little more and perhaps tell us how that has translated into some of the recent changes that we have made to the diversified funds.
Sure. So, and there's more information on this within the white paper on the website, but the changes that we made really fit with four key areas. The first is around equity home bias, and so we've reduced the allocation to Australian equities from being 50% of the global equity allocation, of the equity allocation down to 40%. And this for us is really about managing, that concentration risk that comes with such a large skew to our home market. But we're also trying to balance some of those, local considerations such as tax. Secondly, we've removed the overweight to real estate investment trusts or REITs. So they still comprise a component of the portfolio because REITs are actually a decent weight within both the global equity and Australian equity allocations. But when you go overweight the REIT sector, you can really start to see an increase in individual stock concentration. Just to emphasise that point, if you look at the Australian REIT index, over 50% of that index is concentrated in just 4 companies. Thirdly, we've reduced the home bias within the bond part of the portfolio from 40% down to 30%. Again, increasing diversification by gaining additional access to global bond indices. There's a second component to that as well. So to date, we've been getting our exposure to global bonds through 2 components, both the credit and government components of the Barclays indices. We've now rolled that into one index, and we get that exposure through the Barclays Global Aggregate. So that comprises both government and credit. It actually covers a broader spectrum of global market cap and it's more diversified by both sort of individual name as well as segments of the bond markets. And we feel those changes we've been able to make without compromising our expectation for future returns. The last one relates to currency and actually introducing a partial hedge for our global equity allocation, which is hedging out 30% of the currency risk there. And this actually interacts with the first point around equity home bias, that when you reduce your allocation to Australian equities and increase to global equities, you are increasing your overall allocation to foreign currency risk within the portfolio. And so we're introducing a hedge to appropriately manage that. If you think about a theme across each of these changes, we just emphasise that this is not short-term tactical about making a call on the markets. This is about improving the mix of diversification in the funds without compromising, our expectations for future returns.
Thanks, Aidan. I think that gives the audience a great perspective on how we build the diversified funds at Vanguard. Tim, moving on to research. Morningstar conducts comprehensive research on each fund manager's offering. Can you tell us how Morningstar defines a quality fund?
Sure. So there's basically what we call the 5 Ps to our research process, things we're looking at to really identify those funds that have a competitive advantage and those that don't. So we're looking at, in order, the people, the process, the parent, the price and the performance. And so as we look at that specifically to diversified funds, we're really looking to identify those managers that have a clearly articulated and identifiable process. They have the right skills and experience amongst the people looking to implement that process. It's offered by a firm, i.e. the parent, that treats unit holders well and looks after them and isn't launching the latest and greatest, trendiest funds out there. That, from the price perspective, obviously the lower the cost, the better chance you've got of beating peers over time. And lastly, of course, the performance. But importantly, that is the last thing that we look at, and we're certainly looking at longer term performance in context rather than any individual shorter term periods amongst that. And so those 5 factors we're looking to identify and separate the good managers that are quality, that have clear identifiable competitive advantages in each of those areas relative to their peer groups.
And I guess following on from that, our range of diversified funds have been rated gold by Morningstar. How did you go about actually rating the diversified funds and what criteria did you apply to those?
Sure. So, the criteria is the same for everyone. I should point out, so on our rating scale, we have gold, silver and bronze, which are our positive ratings for funds. We have neutral for funds that we think are middle of the pack, can broadly meet their objectives but don't have clearly identifiable competitive advantages. And I think the independence of our business model points to or is highlighted by the fact that neutral is the most frequent rating with which we use out there on funds, and those of you that use Morningstar Research would be aware of that. And finally, we have a negative rating for funds that we think are fundamentally flawed. Specifically on the Vanguard Diversified range achieving its gold rating, if you think back to each of the 5 Ps, we clearly think that there's a process in place that is robust, that's repeatable, that has worked over time. We think the people who are responsible for executing that certainly have the appropriate skills and experience to do so. Vanguard as a parent has proven itself to be very unit holder friendly over time, and that's been reflected in the next P on the price. We've certainly seen consistent reducing of cost of funds over time, and that's certainly friendly for unit holders and gives each individual fund a better chance of beating peers over the medium to long term. And then lastly, on the performance perspective, certainly the Vanguard Diversified range has fairly continually beaten the peer average over most timeframes with which you look at. So in aggregate then, across those criteria, Vanguard achieves a gold rating.
Thanks, Tim. It's really interesting to understand how Morningstar rate the funds and specifically the diversified funds. So I just want to thank those of you who submitted questions prior to the webcast. I'd like to cover a couple of these now and then move on to some of the live questions that are coming through. But a common theme that we're seeing is the question of how regularly are the diversified funds rebalanced, and is there a tolerance? Aidan, that's probably one for you.
Great. Happy to take that one. So, there is a rebalancing and a tolerance range in place, which for our funds is 2% at the individual asset class level. And it is really important to have that range in place I sort of liken it to driving down the freeway in your car. When you think about it, you can be right in the middle of the lane. If you sort of move 6 inches either side of the middle of the lane, it's not actually increasing your risk of something unexpected happening all that much. It's really only when you start to veer outside the lines that you're really starting to increase that risk. And it's exactly the same with our funds. So by having that rebalancing range in place, you're not burning costs by trying to keep the funds exactly in the middle of the lane when slight drifts either side really don't change the risk profile. In practice, the way we actually see this happening, sort of thanks to a lot of the support that we get from all of you with the diversified funds, is that we get to use daily cash flows to rebalance back to that strategic asset allocation very cost effectively. In practice, actually, the number of rebalances that we would do outside of that daily cash flow, which takes pretty large market moves, is only about sort of once or twice a year.
Right, and I've just got another question here for you, Tim. You've got great insight into managed fund trends, both in Australia and globally. How are the funds and investment managers evolving around the world from your perspective?
Yeah. So there's a couple of key themes that really permeate, I think, not only locally but right around the world. I think one of those is certainly the development of more retirement-specific products. Clearly the ageing demographic is an issue here in Australia, but also around most countries in the developed world. And so we're really seeing development of products in that area. And I think the other thing that again is a trend right around the world is an increasing focus on cost. That's happening in every asset class in just about every country around the world. Part of that is regulatory driven. Part of it is a recognition that the lower your cost over time, the higher your chances of outperforming or beating relevant peer groups in the medium to long term is. There's certainly a number of academic studies that have demonstrated that. And so with increasing focus on cost, that's certainly influencing where money is flowing and also how products are being launched and structured.
Great, thanks. We've had a number of questions specifically about how the diversified funds can be used as part of a core satellite portfolio. Aidan, can you share some insights with the audience on this?
Sure, absolutely. And probably the first thing to say in relation to that is that for many investors, we feel very confident that getting the asset allocation right, diversifying risk, keeping costs low, staying the course, actually gives them the best chance of investment success. But we do acknowledge that for some investors, particularly with unique objectives, having exposure to an active satellite can actually be in their best interests. Now, in order to get the value from that, it's critical that they're able to identify sort of talented managers. They can get that at a reasonable cost, and that those investors actually have the patience to stay the course as well. And probably the other aspect to that, so that's almost the criteria for considering a satellite. What is the right amount? Again, we sort of frame that with 4 key questions. What's your conviction that the product you've selected is going to deliver out performance? What's the cost? So you're not competing away that benefit that you're hoping to capture by using the active satellite. And looking at the level of active risk within that portfolio as well, and then understanding the tolerance of your investors to that active risk. If you can actually ask those 4 questions, that's going to really help frame what the right mix of core satellite is for the portfolio.
Great, and I'd just like to actually move on to some of the live questions that we've got coming through. And the first one I can see here is for Tim. So Tim, how important is strategic asset allocation when you're rating funds?
In the diversified space, it's crucial. Asset allocation is going to determine the vast majority of your total return, over time. And so, therefore, the inputs to your strategic asset allocation, the method and process behind that, the robustness of the methodology are all really important. Equally too, the sensibility checks around the outputs of that are, equally important to work out. Does the structure of those portfolios, make sense to help clients meet their goals depending on the risk profile that they end up in? So I think that's a crucial part of how we assess the process, key element of it when we're looking at our multi-sector funds coverage.
Right. And Aidan, the next question is for you, and it's around alternative funds. So, in your view, on the use of alternative funds, what's your view on the use of alternative funds as part of a diversified portfolio?
Yeah, great question, and not dissimilar to the way we sort of think about core satellite, but perhaps some nuances that we can draw out. And again, alternative funds may be something that's applicable for some investors, but when we think about how we construct the diversified funds, it's about them being broadly applicable to a wide group of investors, keeping costs low, being really transparent so they deliver what those investors expect. When you incorporate alternatives into the mix, there's some things that you need to recognise. And first of all, alternatives tend to have much wider dispersion than the kind of traditional market cap exposures that we've built into the portfolio. And that means, returns that you don't expect or may not expect on both the high and the low side. In addition to that, some of the characteristics need to be understood. So, with alternatives, they tend to be higher cost. That's a challenge when we look at them and how we might incorporate them into the portfolio. Greater levels of complexity and not the same degree of transparency. And they're actually characteristics that investors really need to understand and be on board for if you're going to incorporate alternatives in the portfolio. And so we really don't see that they would play a role in this index diversified series.
Yeah. And the next question is actually on a similar theme. Why is there no Australian small company exposure in the diversified funds range?
Yeah, well, that's a great one to clarify. And certainly our philosophy is that we want to give investors broad market cap exposure within those funds, whether that's small caps, emerging markets, in proportion to what you truly define as global market cap. And we do have market cap exposure to small caps, but we get that in a couple of different ways. Firstly, with global equities, the MSCI developed index doesn't have small cap exposure in there, and so we allocate to a dedicated global small cap index in order to fulfil our global equity small cap exposure. For Australian equities, the benchmark that we use is the S&P ASX 300, and small caps are actually a component of that benchmark, so roughly stock 101 to 300. So for both the global equities and Australian equities, our diversified funds do have market cap representation within the small cap space.
Okay, great. And Tim, the next question that's coming through, you touched on it before, but perhaps you can expand a little bit. What are you seeing at Morningstar as the general trends in the marketplace in terms of diversified funds?
Yeah, so we've seen a lot of new product development in this area more recently, what I'd loosely call objective-based funds, and that's a sort of a fairly wide, all-encompassing bucket. There's certainly been lots of products come to market in recent years, applying more flexible asset allocation approaches, promising to deliver often inflation-linked or real returns. It's certainly been an area of increasing focus for us. I mean, I think in many ways, as a generalisation, the jury is still out on many of these styles of approaches, given they've only really been launched in the last couple of years and for the most part haven't been tested through a market cycle. But it's certainly an area within this sector of increasing product availability and therefore increasing focus in forming a view on our part when we're researching the overall sector.
Great. And yeah, we've just had a question come in about strategic asset allocation for you, Tim, as well. How much research did Morningstar do around the optimisation and effectiveness of strategic asset allocation? Noting that Morningstar have in the past provided strategic asset allocation. Yes.
So, yes, we do provide a strategic asset allocation framework ourselves for users of our research through our products. But in terms of if the question is more on how do we assess that within the various funds that we rate, including from Vanguard and the various other providers, it's not that Morningstar has all the answers to strategic asset allocation. We have an answer which we think is obviously appropriate for those using our research. But when we're assessing the various approaches of different fund managers out there, it comes back to what I said earlier. What is the process? Does it make sense? What is the methodology behind it? What is the what's the credibility of some of those inputs, and then what is the credibility of the outputs? Because often, you can be various models that sit behind these things, but if it spits out answers that don't don't pass us a common sense test, and I think that's equally important that part of our process of an assessment as well. So there's a range of ways to think about approaching strategic asset allocation. No one way, whether it's us doing it or Vanguard doing it or anyone else doing it, is the answer for everyone, but certainly we're trying to identify those that have a better chance than most of separating themselves from the crowd.
Great. And Aidan, one for you now. We always advise clients to invest in what they know. Mm-hmm. So why is home bias such an issue?
In terms of the philosophy behind that, we'd absolutely be on board that, simplicity, transparency, investors understanding what they invest in is, one of the best ways to get them to stay the course. But we do also know that when investors have a large part of their portfolio skewed towards whether it's an individual market or sector, they need to accept what could be differences in returns that may actually mean that they jump ship on their strategy at the wrong time. Maybe one way to answer that, and I'm actually going to draw from an anecdote that an advisor had at a recent roundtable in Sydney, where to get their clients familiar with equities, they'd sort of talk about things like Transurban, and every time you go under the sensor on the freeway, it beeps, and that's an extra $5 that sort of goes to the bottom line of Transurban. I'd probably apply a similar principle on the global equity side, and perhaps there's an opportunity for education. If you can get your clients comfortable with what they're investing in, whether it's the Apple laptop that's sitting here on the table in front of Rebecca, or the Volkswagen they drive, or every time they put a Johnson & Johnson Band-Aid on their child's finger, these companies are representative of global markets, because there is that benefit in diversification.
Great. The next question might be for both of you, actually. We'll start with Tim. Is there a magic number of funds needed to achieve true diversification?
In short, no. There's no right answer to that question. I think there's the answer certainly could be one. I mean, certainly when we look at many diversified funds and how they're applied, how they're used in the market, they can be a one-stop solution in many cases. You need to obviously have appropriate diversification within that, both by asset class and then underlying exposures. But in many cases, for many of the diversified funds on our coverage list, including Vanguard, they could easily play a one-stop solution. Equally too, though, particularly if you think about a core satellite approach, then you could definitely complement that with other funds or other asset classes out there. So whether that's things like alternatives that aren't represented in this SAA approach, whether that's other particularly active approaches within traditional asset classes that for whatever reason you might want to have a particular tilt or exposure to, all of those could appropriately play a role in a portfolio.
And Aidan, just for you, why have you removed all the allocation to listed property from a portfolio?
Yeah, sure. So again, sort of going back to those four key areas for the changes that we made. For the real estate investment trusts, we haven't removed them from the portfolio, so we've taken out the overweight. They actually comprise nearly 9% of the Australian equity index. Less than that on the global side, but I think one of the things that's important to recognise is that people sort of see that extra line on the asset allocation table and think that's adding diversification, but you need to look underneath at the characteristics of what you're introducing to that portfolio, and particularly with some of the stock concentration within the Australian real estate index, we think that what you are getting by overweighting that is actually additional concentration rather than the diversification that people are really looking to capture.
Yeah. And do these changes that we've made translate through to our ETF range?
They do. So we recognise investors implement their strategy in a range of ways, and for the exchange-traded funds, we have revised our model portfolio. So for the changes that we've made to the diversified funds, they have been reflected in those model portfolio changes for the ETFs and there for investors to use.
Great. And Tim, there's a question here for you. How often do you re-rate funds, and is there anything that would cause you to look at the fund ratings again?
Sure. So we work on an annual review process. So we're looking, therefore, typically at each fund on an annual 12-month cycle. That being said, within that, if there is a material change, at a fund, we will reconsider that rating as and when appropriate, as soon as possible. Particularly if there's been like a major portfolio management departure, an organisational change from an acquisition or a divestment of a particular asset manager, or some major fundamental change to a process. So base case is certainly once every 12 months, formally reviewed, meet with the portfolio managers and then go through our ratings process to either reconfirm or alter our view. But then where there is a material change within that cycle, then we will address that as soon as we can and reissue any ratings updates as appropriate as soon as practically possible.
Okay, I think we've only got time for a couple more questions. I've got one here for you, Aidan. What is the duration of the fixed interest component of the diversified portfolio funds, and how will this fare in a potentially rising interest rate market?
Yeah, really great question, and this is probably one of the questions we most get and one of the ones we most like to answer, because I think there's a lot of misinformation out there in terms of the role that duration plays in a portfolio. The duration roughly is about sort of 5 to 6 years for that, the bond component. And, in a rising rate environment, there's some things that are important to understand. Firstly, you might get rises in the cash rate. That doesn't necessarily mean it translates all the way through the curve. So you don't necessarily see as damaging an impact to your bond portfolio as what some people might anticipate when you get interest rate rises. The other aspect too, in terms of understanding how that duration actually works. So if you've got a bond benchmark of 5 to 6 years and interest rates rise, you're now getting a higher coupon and a compounding effect as that gets reinvested. So actually there's a break-even point there. And so one of our key messages for investors when we sort of see that fear of duration in a rising rate environment is that rising rates is actually really good for investors, so long as they've got that medium to long-term view.
That's great. Well, actually, I can see that our time is almost up for today. Aidan, a final question for me. In the current market environment, do you have a view on what's really going to drive long-term investment success?
Yeah, and for me it's simple, and I sort of start with the fact that asset allocation explains sort of roughly 80% of return variation in the portfolio. And so for an advisor to really understand the goals of their investors, get them in the right asset allocation, be well diversified, keep costs low, and get them to stay the course, is a great way to achieve investment success. And sort of implicit in the last part of that statement around discipline is the critical role that we see advisors playing as a behavioural coach. The cost of clients losing their conviction at the wrong time can be catastrophic. So, to get them invested in a well-constructed portfolio and be that strong behavioural coach, we believe is the way to deliver investment success.
Okay, and Tim, did you have a perspective on what's driving long-term investment success?
Yeah, many similar things. I think have a plan, implement a process, stay the course, keep costs under control, and periodically reevaluate and check that you're making progress along that path. But certainly, keep a long-term framework in mind and don't try and get too caught up in much of the short-term noise and make bad decisions as a result.
Great, thanks Aidan and Tim. I think we've really provided the audience with some great insight and information today around diversified funds, and no doubt you'll have other questions in the coming days and weeks, so please feel free to contact our sales team. A couple of final messages from me. At Vanguard, we are focused on delivering value to investors. Reducing our fees on our range of diversified funds to 29 basis points demonstrates our commitment to delivering low-cost, high-quality investments for you and your clients. I just wanted to thank Aidan and Tim for your contribution today, and thanks to everyone for all your great questions and joining us. We'll be sharing some further resources with you, and just a reminder that the webcast will be accredited by the FPA, and you can receive CPD points by completing the survey on the tab to the right of your screen. We'd welcome any feedback and suggestions for topics that you'd like to hear about in the future. Enjoy the rest of your week, and thanks again for your time.